Your performance report contains two returns, plus 20% followed by minus 20%. The arithmetic average is 0%. So the investment broke even, right? Not quite. Start with 100 reals. After the gain, you have 120. Lose 20% from that new amount, and you finish with 96. The average says 0. The wallet says minus 4. Neither calculation is broken. They are answering different questions. This episode is about three different questions. What was the ordinary average of the listed periods? What constant return would recreate the compounded journey? And what did the investment gain or lose from beginning to end? Those questions lead to arithmetic mean return, geometric mean return, and cumulative return. First, we will slow the journey down and see why the second return is applied to a different amount from the first. Begin with 100 reals. A 20% gain adds 20, so the new value is 120. Now the base changes. The next return is not applied to the original 100. It is applied to the current 120. A 20% loss from 120 removes 24. That leaves 96. Equal looking percentages can create unequal currency changes because they are applied to different bases. The cleanest way to represent that process is with growth factors. Add 1 to each decimal return. Plus 20% becomes 1.20, minus 20% becomes 0.80. A factor above 1 grows wealth. A factor below 1 reduces wealth. We multiply the factors because each period acts on the amount produced by the previous period. Now we will combine the entire journey and answer one question only. How much was gained or lost from the original start to the final end? Multiply the period growth factors. 1.2 times 0.8 equals 0.96. That total factor means the ending wealth is 96% of the starting wealth. Subtract 1, and the cumulative return is negative 0.04, or negative 4% over the complete two-period holding path. This number answers the full path question. It is not an average per period. Next, we will calculate the familiar average, then define exactly what that answer describes and what it does not. The arithmetic mean treats the two returns as two listed observations. Add plus 20% and minus 20%. The sum is 0. Divide by two periods, and the arithmetic mean return is 0% per period. This calculation is completely correct. It describes the ordinary average of the period returns we listed. The mistake is not calculating 0. The mistake is calling 0 the realized compound return. Arithmetic mean does not say that 100 reals remained 100 reals. It does not automatically describe the constant rate that generated the ending wealth, and it is not a forecast of the next period. It is an average period description. Useful, but attached to a narrower question. We now need a different average, one constant rate that could replace the uneven journey and still reach the same ending wealth. The original journey used plus 20%, then minus 20%. The geometric mean asks us to replace those two different returns with one identical return repeated twice. That constant return must begin at 100 and finish at 96, the same ending value as the original path. It is not averaging the visible heights of the percentages. It is finding the equal growth step that reproduces the total compounded factor. Begin with the complete growth factor. 1.2 times 0.8 equals 0.96. We need one equal growth factor for each of two periods. So take the square root of 0.96. That gives approximately 0.979796. Subtract 1, and the geometric mean return is approximately negative 2.0204% per period. Now check the interpretation. Start with 100. Apply approximately negative 2.02% once. Then apply the same rate again. The ending value returns to approximately 96. That independent reconstruction is why the geometric mean belongs to the compounded path question. We can now separate all four numbers. 0% is the arithmetic mean per period. Approximately negative 2.02% is the geometric mean per period. Negative 4% is the cumulative return over both periods. 96 reals is the ending wealth. They are not four competing answers. They are four measurements of the same path. Next, we will compare two return paths with the same arithmetic mean and see why the more uneven path can produce less compounded wealth. Consider two two-period paths. The smooth path returns plus 5%, then plus 5%. Its arithmetic mean is 5%. Starting from 100, it ends at 110.25. The volatile path returns plus 20%, then minus 10%. Its arithmetic mean is also 5%, but 100 becomes 120, then 108. Same arithmetic mean, different cumulative return, different ending wealth. This arithmetic to geometric gap is the usual intuition behind volatility drag. As comparable period returns become more dispersed, the geometric mean generally falls further below the arithmetic mean. But volatility drag is not a fee. It is not the same number as volatility. It is not automatically the cumulative loss. And it does not predict that an investment must lose money. It describes how variability interacts with multiplicative compounding. When every growth factor is positive, arithmetic mean return is at least as large as geometric mean return. They are equal only when every listed return is identical. For reasonably small returns, a useful approximation says that geometric mean is approximately arithmetic mean minus 1/2 of the return variance. It is intuition, not a replacement for the exact geometric calculation. Here is an important nuance. If you have the same fixed collection of ordinary period returns with no external cash flows or state-dependent rules, changing their order does not change terminal wealth. Multiplication is commutative. The order can still change the interim drawdown. An order becomes economically important when deposits, withdrawals, daily leverage resets, dynamic exposure, fees, caps, or margin constraints interact with the path. We will now convert compounded growth into an equivalent annual rate and connect the geometric mean directly to the log returns from the previous episode. If a holding path lasts several years, compound annual growth rate asks for the constant annual rate that reproduces the total growth factor. Add 1 to the cumulative return, take the root matching the number of years, then subtract 1. The same logic explains why 1% per month for 12 months produces approximately 12.68%, not exactly 12%. Every new month compounds on the amount already built. The previous episode showed that simple growth factors multiply while log returns add. Take the natural log of every growth factor, average those log returns, then exponentiate. The result is the geometric mean simple return. This is another route to the same answer, not a different definition of performance. Finally, we will turn the formulas into a decision guide, check the data boundaries, navigate the Fintech Builder lessons, and run the verified implementation. Use arithmetic mean when you want the ordinary average of comparable one-period returns. Use geometric mean when you want the constant period rate reproducing the realized compound factor. Use cumulative return when you want the complete beginning to end gain or loss. Use compound annual growth rate or annualized geometric return when you need an equivalent annual compound rate. Use variance or volatility when the question is dispersion. And use a forecasting model, not a historical average alone, when the question is what happens next. Before averaging or compounding returns, verify the contract. Every observation must describe the same period length and the same return definition. Do not mix price returns with total returns. Dividends, fees, taxes, foreign exchange, and corporate actions need one declared basis. Missing returns must not silently become zero. External deposits and withdrawals require cash flow aware treatment. A return of negative 100% is a terminal wealth state. and intermediate values should retain sufficient precision until the reporting boundary. On the fintech-builder.com, begin with holding dash period and cumulative return. Highlight why plus 10 followed by minus 10 does not return wealth to its starting value. Then show the growth factor rule, the 4 calculation steps, the synthetic example, and the playground. Next, open arithmetic versus geometric average return. Highlight the one-sentence idea, the definition contract, the arithmetic and geometric formulas, the plus 20 minus 20 example, and the independent wealth check. Finish on return annualization and de-annualization, where the same product and root logic becomes an equivalent annual rate. The library also exposes the cumulative return and arithmetic versus geometric calculations directly. Pin the package version used for the recording, run both functions on the same return array, and compare the outputs with the hand calculation. For plus 20 and minus 20%, the total growth factor is 0.96. Cumulative return is negative 4%. Arithmetic average is 0, and geometric average is approximately negative 2.02%. Matching code and arithmetic confirms implementation parity. It does not prove that the input returns describe the correct financial question. Final kicker. Volatility drag is real, but it is not a separate fee. The arithmetic mean is valid, but it is not the realized compound path. The geometric mean reproduces historical compound growth, but it is not automatically a future expected return. And cumulative return describes the complete path, not an average period. Now the quiz. Path A returns plus 5% twice. Path B returns plus 20%, then minus 10%. Both arithmetic means are 5%. Which path ends with more money? Path A ends at 110.25. Path B ends at 108. The smoother path has the higher geometric mean and the higher cumulative return. Next, we will take this compounding engine and move money between dates using present value, future value, and discounting. Continue with time value of money, present value, future value, and discounting. Find the complete learning path, source code, and visuals at thefintechbuilder.com.